When most people think about financial advisors, they picture stock picks, charts, and market predictions. But here's the truth, portfolio construction isn't about beating the markets with the next hot tip. It's about building an engine that gives you the highest probability of reaching your goals, while keeping costs low, risk managed, and your plan on track. And that's where evidence-based investing takes a very different path than traditional advice. So let's talk about what portfolio construction and evidence-based investing really is. Although it may not look like it sometimes, a portfolio isn't just a random collection of investments. It's a carefully designed system built around three things. Number one is going to be your goals. This can include your retirement, your family, your legacy, or your lifestyle. Number two is going to be your time horizon, which essentially means when are you going to need to use this money? And then number three is your risk capacity, both financially and emotionally. So when you're building an investment portfolio, these three factors need to be taken into consideration and then used in evidence-based investment process in order to have that perfect pairing. Proper portfolio construction comes from using these three areas to make sure that your portfolio is properly structured in accordance to what you actually need. Evidence-based investing is the application of decades of academic research to help us understand how the markets work and how to approach them using a scientific methodology, not opinion. Traditional investing or opinion-based investing often focuses on trying to predict the next best stock, sector, or country. Evidence-based investing flips that idea around. Instead of speculation, it focuses on three core principles. Number one is going to be broad diversification, and it comes from the logical idea that we don't know which area of the market is going to do better or worse in any given year. Being broadly diversified across companies, sectors, and geographies helps make sure that not all of your eggs are in one area of the market. Number two is going to be keeping costs low, because in fact, fees compound against you. Number three is discipline factor exposure. Factors come from the world of academia and this idea of evidence-based investing using a scientific methodology. Factors can be defined as characteristics of companies that explain the relationship between risk and reward. And over time, they have been shown to have higher expected returns. Examples of these factors are smaller companies, lower priced value companies, and more profitable businesses. Leveraging these three elements of evidence-based investing actually helps to eliminate three of the major areas that hurt investors: market timing, higher fees, and stock picking. This allows you to have a system that's designed to take advantage of the power of the market, not just trying to outguess it. So let's talk about the three major areas with traditional or opinion-based investing. Many investors fall into one, if not all three of these traps. Number one is going to be stock picking, and that's just trying to find the next big winner, whether it's next big company, sector, or even country. And then we have number three, which is chasing performance, and that's just trying to buy whatever did well last year or within the last 5 years. So why is this a problem? Well, research shows that people who try to use any of these strategies end up underperforming both the market and their own relative investments. One of the main explanations for this is because these strategies are centered around emotional decision making. Let's talk about how evidence-based investment portfolios are built. Number one is a risk and goal assessment. You need to know how much risk you need to take to achieve your goals, but not at the cost of volatility, because if you have too much volatility, you'll panic and abandon the plan. This assessment will inform your asset allocation. The asset allocation is a mix of stocks and bonds you own. The theory goes the higher percentage of stocks you own, the higher opportunity for growth you can get, but there is going to be more volatility or ups and downs along the way. That's why we incorporate bonds. Bonds reduce the volatility, but they also reduce your growth potential. This is paired with a globally diversified investment strategy, meaning the stocks and bonds you own are diversified across companies, sectors, and geographies. Then we have factor exposure, which is a concentration within your portfolio towards the characteristics of companies that have outperformed in the past. These characteristics are smaller companies, cheaper or value companies, or higher profitability businesses. These are the areas of the market that academic research have shown to deliver higher expected returns over the long run. Now, with that foundation, it's important to have a tax-aware design, which means you have the right assets and the right accounts to minimize tax drag. In addition to this, it's important that you have a systematic rebalancing process, and that's essentially just making sure that your portfolio stays within the parameters of your risk tolerance. And last but not least, behavioral coaching, which is keeping you invested, especially when emotions run high. So let's talk about the research that confirms this work. Vanguard found that discipline planning and rebalancing can add about 3% net annual value per year. Morningstar showed that optimized planning can increase retirement income by nearly a third. Then there's a countless academic studies spanning decades, including the Spiva report, showing that broadly diversified, factor-aware strategies outperform most active managers. It's so important to remember, when it comes to investing, it's not about the home runs. It's about consistency, efficiency, and letting compounding do the heavy lifting. So let's start with a real-world example. There was a family that had $2 million invested across 12 different mutual funds. On the surface, it looked diversified, but underneath, they had an overlap in holdings, higher fees, and tax inefficiency. By switching to an evidence-based, globally diversified, factor-aware strategy, they can reduce their cost, increase their diversification, thereby decreasing their risk, and ultimately increase their long-term expected returns. This not only helps them increase their financial outcomes, but most importantly, increase their confidence that they'll be able to stick to their plan over the long run. So let me ask you, is your portfolio built on evidence or opinion? Do you really know how much you're paying in fees and how tax rate can be eroding your long-term returns? Do you have a disciplined strategy that you can stick to through market ups and downs? If not, what you need to do is download my evidence-based investing checklist to see if your portfolio is truly disciplined. As always, thanks for watching. Hit the like and subscribe button if you want to watch more videos like this, and comment if you have any questions or thoughts.